economy is set to grow at 6.5% in the current fiscal, the lowest in 4 years, as agriculture and manufacturing act as laggards. Chief statistician TC Anand says the advanced estimates are on the conservative side, even as he pegs the second half GDP growth at 7% is the worst over for the Indian economy.
The central bank finally gives in to the pressure from North Block. Reports suggest that RBI has given the green light for an extra dividend of 13,000 crore rupees, which will help the government partially offset the revenue shortfall. Economists red flagged the move, warning the government and RBI for setting a dangerous precedent.
Caught in political crossfire is the triple talaq bill as the winter session of Parliament concludes without passing that piece of legislation in the Rajya Sabha. Chairman of the Upper House, Venkaiah Naidu, says it's been a positive session with 9 key bills getting the green light. The budget session will commence by the end of this month.
Dalit leader and Gujarat MLA Jignesh Mevani hits out at Prime Minister Modi for his silence on the attacks against the community in Pune just a day after he was booked by Mumbai cops for inciting violence. Mevani says he has done nothing wrong, even as he accuses the BJP government in Maharashtra of political vendetta.
It's a big blow for India's #1 airline, Indigo. A parliamentary panel pulls up the carrier for mistreating its passengers, from poor quality of services to extremely rude behavior of the airline's employees. A House panel report lists out how Indigo tops the list of domestic carriers and ill-treating its passengers. But on the same day, Jayant Sinha, the Minister of State for Civil Aviation, asserts there can be no capping of airfares.
Another big blow for Pakistan as the US walks the talk by freezing all security assistance to Pakistan until it takes decisive action against terror groups, including the Afghani Taliban and the Haqqani network.
Former Uber chief executive and founder Travis Kalanick is likely to sell almost a third of his stake in the cab-hailing app months after his unceremonious ouster from the company. Deal to value Uber at a jaw-dropping $48 billion. Great evening to be with you right here on ET Now. This is the India Development Debate. I'm Supriya Srinath, and straight on to a big topic of discussion tonight then. Let's get you the bad news first. The Indian economy will grow at a much slower pace of 6.5% this fiscal compared to 7.1% last year. And the not so bad news is that growth in the second half will be a healthy 7%, a markup of nearly 1 percentage point from the first half. Read these data points along with Chief Statistician TC Anand's remarks that the growth forecast for fiscal year 18 is on the conservative side. Looks like all is not lost for the Indian economy. Here is one more number that confirms the recovery theory. Gross value added, or GVA, growth in the second half has been pegged at 6.4% in a marked increase from 5.8% earlier.
On the flip side, the worst fears about the negative impact of GST may have come true. Gross fixed capital formation, a benchmark of private investment, is seen at 37.65 lakh crore rupees, a marginal increase from the previous year. Also, the government says there could be some minor giveaways on the fiscal deficit front, but what's more worrying is the big fall in farm output growth, which is now pegged at just 2.1% for FY18 versus 4.9% in the previous fiscal. With less than a month left for the Modi government's last full year budget, what do these numbers signal? Tonight's India Development Debate is all about the state of the Indian economy. Joining us, of course, is Dr. Rajiv Kumar, Vice Chairman of the Niti Aayog and this IDD Direct. Thank you, Dr. Kumar, for taking the time and joining us here at ET Now. Firstly, what this data seems to reflect is that growth is lower than what was anticipated. And if you see this in the context of the fact that inflation is likely to come in higher than what was anticipated, and we don't have a tailwind in the form of lower crude prices that we had for 2 years, are you a little worried about how the macro situation is adding up at this stage?
Actually, I'm afraid not. I'm not at all worried. In fact, I thought this was a reaffirmation and a vindication of what I've been saying since about August or September, that the economy has bottomed out in the first quarter of this fiscal year when we hit 5.7%. And you've seen that this is a consistent growth since then. We had 6.3 in the second quarter, so and given that you've got 6.5% for the whole year, implies that the growth would be about 7% in the second half. And so for me, it's extremely good news, which shows that the economy is now recovering. And the big thing is here that it comes with some very good forward-looking numbers like the PMI for manufacturing jumping up to a 5-year high. So I don't think at all that I am worried. I don't think anybody else should be worried. As far as the oil prices are concerned, I think they're beginning to stabilize. Yes, they have increased in the past, but I don't see in the last few weeks, at least 3 weeks, they haven't shown any further tightening of the oil prices. And the world economy, the global economy is on the rise. I mean, this is after years and years, you have a synchronized growth of the North American, European and the Japanese economies, which will be the sort of tide which will benefit us as well. So I'm afraid I read the situation quite differently from what you do, and I think we should see a robust recovery going forward into 2018-19.
Mr. Kumar, I'll take a quick minute and talk to you about the CSO's projections of 6.1% on GVA, 6.5% on GDP. That's lower than what the RBI is projecting at 6.7%. So what's happening here? Is the RBI being too optimistic? Is the CSO being too conservative? And how are you going to read this? You did refer to this early on, but do you believe the CSO, of course, is not taking into consideration the high frequency data that you spoke about, the PMI at a 5-year high or commercial vehicle sales and all of that?
Yeah, I don't know about RBI being too optimistic. That's not something which is natural for them. I mean, though they are the conservatives of the system. But it's between 6.5 and 6.7 is not too much to talk about. I think maybe, Supriya, you're driving too fine a point here. But look at the good news here. If you look at the details, it shows that the construction sector growth, though is still anemic, is now 3.6% for the whole year, as compared to 1.6 for the year before, for the first half, and 3.6 for the second half. Now that's extremely good news as far as I am concerned. See, because I have been looking for signs of economic recovery and whether the cycle has bottomed out. And remember, I do want to repeat the fact that this down cycle started in the last 3 years of the UPA, and is not something that this is of the government making. But can I make just one more additional point? Getting 6.5% after GST and after demonetization compares very well with 1.8% that you got in 92-93 when the first set of reforms were undertaken by the Narasimha Rao government, at which time I was a junior official there. So economies which show a sort of resilience that our economy has done this time does indicate that we are much stronger. We are on a much stronger footing at this point of time, and that the growth will pick up because because demand is picking up. The FMCG stories are now beginning to look very positive. So, Supriya, I am afraid I will not buy your argument about something which is not going wrong. Just one last thing that you said about inflation. Yes, inflation has picked up in the last couple of months, but I am told by people who should know that it will decline again, and we will end this year at around 4.2% inflation. So that there again, I don't think the RBI has gotten any more worried, and that our macro balances are in good shape.
What everyone would want to know is when will the benefits be more visible, the upside of GST and demonetization as well, the structural reforms that you referred to. If 6.5% is the bottom, but when do you see that starting to accrue, and in what form do we measure that?
The GST benefits are going to be substantial, as all of us have known, and there have been estimates in the past that this will give a 1.5 to 2% fillip to the GDP growth. Will start accruing in 2018-19, and this will be in the form of much larger revenue collections, tax collections, which will then shore up our own the fiscal situation and the fiscal balances. But far more important is that it will result in a reduction in costs of production. It will result in a cost of reduction in the cost, transaction costs, in the logistics costs, in the transport costs, and that it will take this economy towards a lower cost economy than what you've had in the past. Please remember that the incidence of indirect taxation earlier, in the pre-GST period, was close to 30%. Now, if it comes down to 18, there's a huge improvement here, and as it should be passed on to the consumer, it will open up new demand vistas of new demand, which will give the boost to economic activity, and as you are beginning to see, as I said, in the FMCG sector. So, but more than GST, let me say that there are a large number of other measures and schemes which are now in place, and and which you have seen going. For example, in the infrastructure sector, in the speed of highway building, in the availability of coal, in the availability of power, and in the improvement in governance. All of that, I think, all of that will be visible in 2018-19 as our economic growth tends towards 7.5% in 2018-19, and then goes beyond that to 8% and above in the year after that.
Fair point indeed, and we'll keep our fingers crossed on both those fronts, sir. But I will ask you a quick question on the gross fixed capital formation. As a percentage of the GDP, it has gone down obviously year on year from 27.1 to 26.4, but as a rate of growth, it has picked up. Now, obviously, the big question is that the government alone cannot do the heavy lifting on investments, and at some point in time, the private sector has to pitch in. My question really is, what will it take for Indian industry to begin parking their funds in big investments, to begin chasing the greenfield projects? I mean, why are they not doing it, and what do you believe will change for them to do so?
I've said this in the past that the rules of the game have changed, and the Indian industry and the Indian investor is quite right in sort of waiting and watching as to say whether these rules have changed for good, or whether they will go back to business as usual sooner rather than later. Now that they know that all of this is going to be there for good, the GST is there, the crony capitalism is out. All of that is more transparent, and it's and you've got business activity which is cleaner, more transparent, more rule bound. I think they will all come back. But the key here, of course, will be a pickup in consumer demand. I was talking to some people yesterday in capital goods sector, and then some in the FMCG sector. There is the fact that agricultural production hasn't gone up as much in the last 4 years as it had done in the previous 4 years because of 3 poor monsoons. But now that when rural demand begins to pick up and the urban demand picks up as well, as in the housing sector and otherwise, the private capital, private investment will come back in. And as you said yourself, although the share in the total GDP has declined, the rate of growth of capital formation is beginning to pick up again. And if you look at the entire capital market, which is corporate bonds, IPOs, and credit offtake from private banks, private commercial banks, you will see that there's been a pickup already. So I see a recovery in private investment coming forth. And this is when the Indian industry will pitch in, because you're quite right, the government can't do all the heavy lifting, but the government has tried very hard to do so and to compensate for the declining private investment. But I'm confident that private investment is coming back, and buoyed by the huge increase in the foreign direct investment, where the foreign investor looks at India as a very good story, and therefore is putting his money where the hopes are, where the mouth is.
Before we let you go, I can't not ask you the question on Indian agriculture. At growth rates of 2.1% versus 4.9% in the previous year, that is obviously a pocket of concern, and there is also cognizance in New Delhi that rural stress needs to be addressed. Is it safe to presume that Budget 2018 will perhaps be hover around Bharat? Will it, the large contour of the budget will be rural distress and how to address it?
Yes, agriculture will receive special attention, but Along with that, I think you will find this budget quite focused on health and education as well, because that is also where we have variables, indicators which don't look so good still, and I think that's something that is badly needed. Reforms in that sector, better delivery, better accountability, but also more resources. On agricultural distress, Supriya, it's not something that you can do immediately. Also because you got to build a coalition with all the state governments, to be able to handle that. So what I expect to happen is that the government will announce maybe a slew of measures to change the approach, the policy approach towards agriculture, and which, for example, let me say, stops focusing on output but starts focusing on farmers' income, and stops focusing on only raising prices but starts focusing on reducing the costs of inputs and also perhaps going towards direct benefit transfers in case of subsidies, rather than continue to use your subsidies which are price based and therefore distortionary. So I think the sort of thing that Yogi Adityanath's government has just done, which is to announce an increase in the price of electricity supplied to the farmers, but at the same time assuring them of much better quality of power supply for 18 hours, which therefore reduces diesel consumption by the same farmers. So those sorts of measures which will help improve farmers' income rather than continue to be obsessed about yields and outputs and stocks and so on. So that's the sort of approach, that's the sort of change that you might find coming into the next budget.
On that note, Dr. Rajiv Kumar, always a pleasure chatting with you, and thank you for your perspective and views as far as the advanced numbers of the GDP are concerned. It's always good to get your views and inform our viewers on that. So thanks very much for taking time out this evening and being with us on ET Now.
Okay, that was Dr. Rajiv Kumar, Vice Chairman of the Niti Aayog, with the government's perspective on the GDP advanced data. But let's take it across to a panel for the debate this evening, and we've got a wonderful panel joining us on the show this evening. Swaminathan Iyer, Consulting Editor of ET Now, Maitri Busnurmat, Consulting Editor ET Now, Shogoto Bhattacharya, Economist at Axis Bank, and Dr. Abhijit Sen, Professor at JNU. Thank you all so much for joining us on the debate and also for waiting patiently as we finish that interview with Dr. Rajiv Kumar. Swami, I'm going to start off with you. Now that it's evident that the slowdown it's turned out to be far more protracted than what one has anticipated, the big question that I'm sure everyone is going to be asking tonight is, was the pain worth it? Was the pain caused by GST, demonetization, those two quote-unquote structural reforms, was it worth it?
Okay, if you're asking me, yes, briefly. I mean, it need not have been so badly bungled. The cost could have been much, much lower than this. But at the end of it all, I say, suppose GDP slowed down by, shall we say, 1%. What, you lost 1%. If you count that as an investment in future improvement in compliance, it means that provided I get just a 10% return would mean an increase in GDP of no more than 0.1%. Is it possible that growth will improve by 0.1% and compliance will improve by a little more than that because of this investment in the long run? I think it is plausible. It is not proven, it would be difficult to prove. It is plausible, but without doubt, the thing to emphasize is that demonetization was so badly bungled and the GST glitches appear to be more serious than they need have been. Had the planning been better, had the computerization, had the number of taxes, had all the paperwork been done in advance. So some of the pain has been excessive, and with better planning there could have been much less pain. Will it in the long run turn out to have been worthwhile? Possibly.
All right, long run, perhaps possible. Will it turn to be worthwhile? But I'm going to take it across to Professor Abhijit Sen. And do you agree with Swami here, Professor Sen, that in a small short word, yes, it was worth it, but if these things could have been done better, things would have perhaps augured well. But do you believe this kind of pain, the fact that we've lost nearly 1.5 percentage point in our GDP, has been worth ushering in reforms like the GST? And I'm not going to call demonetization a reform, but rolling out demonetization.
See, look here. I agree with Swami. Both, certainly demonetization and GST were botched up real big time. What its future is going to hold, we don't know. This entire program hangs on advanced estimates of GDP, which are, very iffy things. For example, and nobody said this so far, a very large part of the step up from 6% growth in the first half of this year to the projected 7% growth in the second half is made up of errors and omissions. If you remove the errors and omissions from the base and from everything else, the rate of growth drops to 5.5%. So these are very iffy numbers. I'm not saying, and given these iffy numbers, there are shoots that you can look at. For example, knowing about agriculture, I'm pretty sure that agricultural growth will turn out to be in fact higher than what is there in these numbers. But overall, I'm not at all sure about where we are going, and I think it's too early to actually make any firm statement on this. Errors and omissions, statistical errors, is the stuff of statistics. Asking the CSO to produce these numbers with essentially 1.5 months of data for the second half of the year is a challenge which I certainly wouldn't have accepted.
It's a fair point. It's a fair point you're making there, because effectively you've got 2.5 quarters of data on the basis of which this extrapolation has been made. But Maithili, would you be as pessimistic as Dr. Sen is, or like a lot of people else are actually a little more optimistic? They believe this data is a little conservative, like the chief statistician himself pointed out today. It perhaps doesn't accurately capture the turnaround that we're seeing in the economy. And if you look at the high frequency data over the last couple of months, whether it's truck sales, commercial vehicle sales, whether it is airline tickets, whether it's freight movements, there are clear signs of a recovery. Steel output, core sector data again was very strong, the last number that was reported. So do you think that this doesn't accurately capture the turnaround, or would you be as pessimistic as Dr. Sen is sounding?
Well, it's a little hard to say. Yes, it is true that the recent high frequency data does seem to suggest that the recovery is stronger than what we are seeing in these numbers. But if you look at the CSO's advanced estimates for the previous year, initially the first advanced estimates for the last fiscal had pegged GVA at 7%. When the final numbers came in, they were revised downwards to 6.6%. So it's very difficult to say today whether the numbers will be revised upwards or downwards. And the fact is, as Professor Sen said, that we are basing these extrapolations basically on just 2.5 quarters of the data. So it's very, very difficult to say how things will pan out. Given the fact that the previous year we had to see the final figures came in lower, it's quite possible that the final figures that we see at the end of the year will be even lower when we get the final figures, which is roughly about 9 months down the line. Because you look at what the RBI had estimated, the RBI had estimated the GVA at 6.7%, and they had said the risks were equally balanced. So as against 6.7, we ended up at just 6.1% GVA. So it's very difficult to say with any certainty whether numbers will be better or worse. I think we'll have to hold our judgment on that.
Let's do the numbers for a bit right now. For us to get to 6.5%, we've got to grow at 7% in the last 2 quarters of this financial year. Saugata, what do you believe will be the drivers of this growth? I mean, what do you believe will drive things up? I mean, I'm presuming one of the things will of course be that the slowdown induced by the GST will wane off, but there have to be drivers of growth for us to get to 7% for the last 2 quarters.
So I agree that, I mean, I'm more optimistic on these numbers. I mean, I think the numbers, the extrapolations that have been done with the 7-8 months of data, the 2 quarters of data, I don't believe quite capture the growth impulses now. So I mean, I'm fairly confident that the actual numbers that come in by end February, when the first revisions come in of these numbers, I have a feeling that the numbers will be higher. I think the RBI's estimate, even our estimates of 6.6, 6.7% GVA, probably turn out to be overly optimistic. I think we'll settle in from some number around about 6.3, 6.4 or thereabout. I'm talking about the GVA. I don't want to get into the GDP numbers now. So you asked, I mean, so why are we so optimistic? So first, as Professor Sen pointed out, as Dr. Rajiv Kumar pointed out, I think the first one that will be revised is agriculture. Because I think the numbers that are now are overly biased towards the Kharif estimates, which as we all know are not very good, so are bad numbers. When the Rabi numbers begin to emerge, and provided of course, I mean there is always that risk of untimely rains, etc. I mean, so presuming a base case of normal Rabi season, I think that is the first one that is likely to be bumped up. From whatever we understand now, I mean, you are seeing bank credit growth beginning to happen. Some part of that is working capital, of course, with the GST, but some part of that is actually some small demand. I mean, it's not big ticket items that are coming in. Together with this, I think you're beginning to read numbers like road traffic growth, toll collection growths, the times that trucks are now taking to move from point A to point B. All of these are beginning to indicate that there is a qualitative improvement in the economic activity. Quite apart from the fact that FMCG data now begins to look like there is some increase in consumption, etc., that is likely to happen. If the MSP, if the Rabi increases begin to happen, that will also boost to some extent, consumption demand. I think we are overly optimistic, pessimistic, on these numbers on exports. I think you will begin to see that export numbers are a little higher. So from both sides, from the output side and from the demand side, there are now sufficient indicators that the first set of numbers, the 6.1% GVA, is actually a low ball, and will probably get to about a 6.3, 6.4 number once the revisions begin to come.
So you'd say the CSOs probably being overly pessimistic, RBI probably being too optimistic, pegging GVA at 6.7%. But I don't want to get too technical, but Swami, this is an important question for our viewers to understand the implications, because these advanced estimates have a bearing on the budget, which is why it's significant to read it like that. Now, the advanced GDP projection for nominal growth has actually lowered nominal GDP from 11.7% that was projected in the budget to 9.5%. What implication will this have on the fiscal deficit number that's likely to be reported, and also on the overall budget arithmetic, according to you, Swami?
Well, the fact that growth is smaller has two things. It means that the denominator, the GDP figure, might be a little lower. It also means that the tax collections are likely to be a little less. After all, if the growth is less, the tax collections are also going to. So where it will pan out exactly just on the statistical thing, I don't know. I don't think it's very important. I think what is of more concern is that there appears to be a distinct shortfall in GST collections compared with anticipations. First, people said, this will sort itself out, 1 or 2 months it will become okay. I think it's very clear now that things are not sorting themselves out. There is a very significant shortfall in GST realizations on a net basis, and the government is now trying to get in and find out, are there ways in which people are trying to evade this? Can we stop that evasion, fix it in various ways? I think you need to get into this very, very fast, because if you don't get into it very fast, there will be a very substantial fall in your revenue, and your fiscal calculations will truly go seriously wrong at a time when you're trying to compress it, and at a time when you really are looking forward to compress it further down to 3.0% of GDP in the coming year.
I think that's a valid point indeed, but if we are actually going to go down to 9.5 versus 11.7 as far as nominal rate of GDP is concerned, Maithili, it has implications on the fiscal deficit directly, like Swami has alluded to. Back of the envelope calculations, where does this land the fiscal deficit really? Because in the month of November, we've already overshot the fiscal deficit target by about 112% now.
Oh, well, absolutely, because if you look at the fiscal deficit number for November and you take the advanced estimate number by the CSO for the present year, the fiscal deficit by November, we've already touched 3.68. That means by November, taking the advanced estimate figure for GDP, the fiscal deficit was already at 3.7%. That's well over the government's budget estimate of 3.2%. Of course, the government can take refuge and say that the NK Singh committee had given them a 0.5 percentage point slippage was permissible in case of structural reforms. So my sense is that the government might take refuge under this plea and say that even if we have exceeded the fiscal deficit, it's within 3.7%, including that plus 0.5%. But the point is that if by November we've already touched 3.7%, there's just no way the government can rein in its fiscal deficit except by cutting its expenditure in the coming months. And it cannot cut revenue expenditure. The only As I said, the only way they can cut expenditure will be by cutting capital expenditure, and that is very dangerous at a time when private sector investment has just not picked up. So overall, I think the message for the fiscal deficit, for capital formation are all deeply negative.
Shogoto, comment on that. Is it a given? Is market beginning to price in the possibility of fiscal slippage now that the data points to that eventuality? And also now we've seen reports come in today by news agencies that the government is, or the RBI has agreed to pass on extra dividend to the tune of 13,000 crores in an effort to help bridge the deficit because of lower, the RBI reported lower dividend this year because of the demonetization exercise. How do you read that move as well? And is the market now beginning to price in some sort of a deviation from the fiscal deficit target for this financial year?
The market has already fully priced in a deviation now from the 3.2% fiscal deficit. Remember, I mean, as a small aside, the growth, the lower growth of nominal incomes, I don't think that's going to have a major impact on. From about, we estimate the fiscal deficit earlier was 3.24, extending it to second digits. Now it will go to about 3.29. So that's not so from 3.2 to 3.3, very small deviation. But the markets have already priced in, and given the fact that there's about a 73,000 higher borrowing from both T-bills and dated securities, offset to a certain extent. Today's bond auction also, a couple of papers got devolved, and even before. So I think that's about 13,000 crores. That's lower than this, which is almost exactly equal to the higher dividend that the RBI is giving. And I think to a certain extent, I mean, I don't think they will go much beyond the 3.4% deviation in the fiscal deficit. Maximum, I think, 3.5%. But I think, I mean, look, we analysts had previously argued that with extremely disruptive reforms, I mean, all countries, whether it be New Zealand, whether it be Europe, the initial impact is negative on growth. And we seem to have forgotten that. And now we have learned that in India particularly, I think we should have factored that in. A disruption in a cash-centric economy like India would likely to be even more disruptive. So I think for this year, I don't think markets are going to look very askance at slippage. But this should be done as a package. I don't think they should just be done as in terms of a pure fiscal slippage, but together with a reform package. If the government can spell it out, articulate that reform package, I don't think markets will take it as a very negative sign.
It all really depends on what do you expand the fiscal deficit for? What will you relent to do? But Professor Sen, do you believe this is a time no better than any for a counter-cyclical stimulus? Because, it's been spoken about in the past, and then there were these considerations on the fiscal deficit. The fact is that the ratings agencies and their stance is now behind us. Moody's has upgraded us. We've got to push growth. And for that, do you believe there is a case for a counter-cyclical stimulus right now?
Well, actually, again, nobody seems to be talking about it. Look at these advanced estimates. There are two very important implications of the second half as compared to the first half of the current year. The first, contrary to what everyone has said so far in this program, inflation is supposed to come down. Second, again, somewhat contrary to the general drift of the argument so far, you've got a situation in which the tax rates, the tax collection is going up very substantially from about 8% in real terms to about 13% in real terms. That explains the big difference between the GDP and the GVA figures. So these advanced estimates are telling you inflation is going to be low, taxes are rebounding faster than, in fact, output is. Now, given that, I think government can afford to take risks. On the other hand, as I said, I don't buy these projections too much because I don't think taxes are going up as much as these numbers look for the short term. for precisely the reasons that the Swami just talked about. And I don't think inflation is going to go down by as much as these numbers are telling us they are. But these are all built into the numbers you are looking in front of you, you are discussing, and you seem to actually miss out the stuff which is coming from the numbers and talking about whatever is in your head.
Important point that you're raising there, Professor Sen. But let me get a quick word from Swami again on the numbers that we've been put out by the CSO in terms of an advanced projection. So yeah, you're right. We're probably taking it at face value. Gross fixed capital formation projected at 4.5% versus the 2.7% on a year-on-year basis. Swami, how do you read that number? Because that's an important number. It sort of gives an indication of whether the investment sentiment is getting back into the economy or not. Now, obviously, as a percentage of GDP, it's actually come down, but the growth has improved on a year-on-year basis. How do you read this particular number?
Basically, we are going from terrible to substandard. I mean, you should be crying at having such a low rate. The rate was much higher earlier and should be much higher now. Not only that, I mean, Supriya talked about, a contra-cyclical move. Excuse me, the world is in a cyclical upswing. We are not in a downswing, we are already in a global upswing, and in this global upswing where every country is doing better than expected, India is doing worse than expected. So, there is a huge stimulus we are already getting from the global economy. I certainly therefore don't see that there is any more need to do any fiscal work out here. I would want to get that under control. I would want to get our tax collection under control. I think those are the important things to focus on. I think it's worth also pointing out that there's, in terms of strategic policy things, there was supposed to be strategic sales. What has happened to those strategic sales? I mean, is the government just going to funk it completely? That they say first, maybe we'll privatize, then no, we won't. We'll have strategic sales, no, we won't. We'll corporatize, no, we won't. So are we just seeing a government that is getting into a deeper and deeper funk as we get closer and closer to the last budget? This does not seem to me a government that is brimming with confidence, and I would agree that the economy is not such as to make it brim with confidence.
Swami, on the larger point of gross fixed capital formation and as a percentage of GDP coming down, but as a gross fixed capital formation rate of growth going up, Shagato, let me ask you this question. And, I'm sure Indian industry tells you something that they're not telling us. Ease of doing business, India has jumped 30 ranks. The government is doing all it takes to clean up the balance sheet of banks so that credit offtake happens and, new projects take off ground. Why is it that Indian industry is not putting its money where its mouth is? Why is it that Indian industry is not willing to invest just yet in greenfield projects or any other way? I mean, is there a crisis of confidence? Can the government not convince them enough? I mean, what is the reason? What would you put your finger on really?
So to keep it very short, I heard something from in the infrastructure space. So this is not my argument, this is his. I'm not going to name names. He said something very true that, the government has till now focused largely on projects, all the stranded projects, etc. Are now the government has done a lot, particularly in the road sector, we all know, even in the power sector, a lot of projects. The problem essentially has been revenue, and infrastructure is a revenue, is a cash flow game. So revenues still not. I mean, the sad plight of the power, the discom sector, the discoms in the power. I mean, he said even on road tolls, say for instance, there's a lot of arbitrariness on road tolls. There's a lot of leakage. I think the government needs to focus on that. I think that's the crux. That's very, very correct. So the government has indeed taken a lot of steps to unplug, unstrand the projects that had run into trouble. But that's not the end of the story. I mean, the revenues, the cash flows have to be freed up, and I think a lot of work that now still remains to be done on the cash flow side.
What do you ascribe this lack of private investment to?
Sorry, was it addressed to me? I think I lost you for a moment. Yes, the lack of private investment, Sanvi, to my mind, essentially is because we still have excess capacity. And until that excess capacity is completely wiped out, or at least close to being wiped out, I think you will not see private investment pick up. Simultaneously, I think banks are very wary of lending. We've seen strong recovery in the IPO space, but most of that money has been mopped up either through the government offers for sales and ETFs, and also in terms of financial services. We've not seen too many IPOs for the manufacturing space. So the combination of two factors, continuance of excess capacity and banks' reluctance to lend, is going to impact private investment. And simultaneously, as I said, in fact, I want to make a small clarification as far as what Sogato said about the fiscal deficit. The numbers that he quoted of 3.24 and 3.3% are what TCA Anand gave if the fiscal deficit actual number were the same as what is budgeted. But we've already well exceeded that fiscal deficit number. So there's just no way that the government is going to be able to achieve that 3.2%, in which case it will tighten its spending. So overall, we're not going to see gross fiscal capital formation look up at all. And that is what is worrisome, because unless investment happens, you are not going to see GDP growth.
Okay, let me take this across to Professor Abhijit Sen, and I want to just turn focus away from all of this and talk about Indian agriculture. Growth rates of 2.1% for this financial year versus 4.9% the previous financial year. Yes, the number could end up being a little better, but the reality is there is a crisis on India's farms, and for very long it seems New Delhi has been in denial. What do you believe the government now needs to do to resolve the problem, perhaps in a more comprehensive way than it has been ever done before? Not just speak about MSP, not just speak about doubling farm incomes, because I fail to understand where will that happen from. But how do they go to resolve this and not talk about the same things that have been spoken about as a part of resolving farm crisis narrative?
Let me actually start with something else. Something you've been discussing for some time, and that's those capital formation figures. Coming back again to the numbers in the advanced estimate, the blip up in growth rates of capital formation is entirely mirrored and almost entirely explained by the growth blip in construction. The growth blip in construction is almost entirely coming from November data on cement production. And these are telling where these numbers come from. And if you're going to actually talk about capital formation maybe dropping a little bit as percentage of GDP, but growth rates are picking up, a lot of this runs on these 1 month figures. Don't pay too much attention, because this 1 month figure, November cement production, was really not any higher than October cement production, when the annual year-to-year growth rate was negative. So this is important. Again, I think we've got too little data to be able to say anything very big. And this actually relates to the question you asked me regarding the farm sector. The one thing we can do about the farm sector is if we can get rural incomes to start growing much faster than what Rajiv, I think, really in his beginning thing said, that, the farm sector, it's a slow-moving sector. Agricultural productivity, agricultural output, agricultural costs, prices often go up and down, but costs, they take a long time to happen. But what can move fairly quickly are incomes, especially if the construction sector starts moving. When people start getting jobs, a lot of it is casual jobs in the farm sector, immediately the farm sector starts feeling better, investment starts becoming more, people feel more confident, and much of the 4% rate of growth during the period I was in the Planning Commission, I would attribute to that, as well as actually looking at other programs which would make people choose what they think they need rather than us telling them what they've got to do. And of course, back it up with technology. But technology is a slow mover. What does move very quickly is the non-farm impetus to farm incomes. And I think that's where we are failing. And I think this data which suggests that something might be moving there is one of those data which is hanging in the air. It rests on the November cement data, which is roughly the same as the October cement data or the September cement data. The reason you get a 17% growth for that is that in November 2016, cement output fell by 20%.
Okay, important point you're making. So, Swami, do you agree there with the point that Professor Sen made on the fact that you need a more, you need to look at non-farm impetus to the farm sector, and also this whole debate, because whenever we look at this, we can't address the farm crisis in 5 minutes, but the temptation from the political class has always been to look at hiking the MSP, creating space for the debate goes back to it. The political discourse is always about higher MSP ahead of an election. Is that the way to look at this problem?
I would say there are a number of complications. One is the strengthening rupee. Because of the stronger rupee, imports have become cheaper than they otherwise were. That, I think, has created a problem in a number of areas, and the government has now tried to react by imposing various kinds of import duties. And this then also creates an issue of, what do you do about agricultural incomes at a time when we used to have buoyant agricultural exports. I think it's also worth pointing out that the Gorakshak stuff must have had an adverse impact, one way or the other, on some of the more better off areas like, our buffalo meat exports were earlier booming. They have not fallen, but they are sort of suddenly leveled off from a boom. That would have affected the leather industry. There would have been other things affected. But overall, I would say that if you look at what is seriously wrong, and this would affect capital investment, it would affect agriculture, other sectors. What has happened to exports? Without rapid export growth of 15% plus, no economy can expect to do 7% GDP growth on a sustained basis. The real reason why industry says, look, there is not enough demand, why should I invest? The main reason is that export demand, which was so high in the 2000s, has suddenly disappeared. Back in the 2000s, our exports were growing at 20% per year. That kind of thing really increased the amount of demand available. A huge amount of investment took place. The economy galloped upward by up to 9%. We are now faced with, once again, export stagnation or very modest growth. So unless we get this export machine going, neither growth nor investment is going to look very good.
Any denying that, especially because you mentioned we were growing at 20% when our growth rates were high, but we are of course growing at only 4.5% for this year as far as exports is concerned. But Shakuto, beyond the rupee and beyond the fact that the rupee has been relentlessly strong and that's hurting exports, enough and more perhaps has been talked about but not done. What would your prescription for Indian exports be? We've talked about looking at newer markets, we've talked about expanding our exports basket, but it doesn't seem to be helping at all. And then, of course, they've reeled under the pressure of the GST.
Yeah. So I think the rupee definitely hurts, but I have a feeling the strong rupee hurts. But I have a feeling it hurts exporters more than it does system-wide exports. Profit margins of exporters fall. I mean, so all individual exporters definitely suffer, and they take a hit on their earnings and profits and cash flows, etc. I'm not convinced at all about how sustainably a strong currency has an impact on exports. I think there are far more fundamental problems in exports. I mean, notice that we are doing fairly well in terms of automobile exports, the engineering exports that we see. So we've built up a good, strong ecosystem for exporting auto components, exporting automobiles. India is emerging as a large hub for small cars exports throughout the world. Unfortunately, we have not been able to replicate that in many other areas. I mean, there are some that Dr. Swami mentioned that in terms of specific buffalo meat exports, etc. So those are individual idiosyncratic exports. But the overall competitiveness, despite our jump in the ease of doing business ranking, I think if you talk to exporters, if you talk to other individuals, so one part definitely for the last 3 or 4 months, I mean, the problems with the export the credit on taxes, export credit, that's become a problem. I think the competition from imports, both in terms of the currency, the stronger currency, as well as the changes in the GST structure of duties on imports, I think that's also put imports relatively stronger as compared to exporters. So these are the immediate things that need to be looked at. I mean, how to provide more capital to exporters, the amounts that are stuck in the GST of components of exporters. But overall, I think, I mean, for an export point of view, look at textiles. I mean, there are countries whose currencies have appreciated much more. But they have done much better in textiles.
Okay. Fair point. And you get quick closing comments from our panel. We're running out of time. Very quickly, Maithili, given these numbers, given these projections, and I know Dr. Sen is sort of questioning the whole entire premise of these numbers, but given what we have today, is 8% growth in FY19 looking increasingly difficult?
Well, 8% certainly does look very difficult. I think the best we can hope for is about 7.5, because remember, even though global recovery will give us some tailwind, the fact is that oil prices are rising. So that is a big problem for the Indian economy, because high oil prices have implications for the fiscal deficit, for inflation, and a whole host of other factors as well, increases costs. So across the board, higher oil prices are a big negative for the Indian economy. So I don't think it will be possible for us at all to reach 8%, 7.5 perhaps, if we're lucky, if the problems that we're seeing with GST temporarily prove to be only temporary, and the government does not back out, doesn't chicken out simply because there is some slippage in its fiscal deficit. Provided it doesn't do that, provided oil prices behave, 7.5 is certainly doable. 8%, I don't think so at all.
Professor Sen, you agree 7.5% is doable and 8% is extremely difficult, and the fact that Maithili also alluded to a big tailwind, oil that is now increasingly becoming a headwind for us going into fiscal year 19.
Well, certainly, I agree with her entirely. 8% is not doable. I still have doubts on whether 7.5 is doable, simply because the world has been doing very well this year. The world economy has been growing, and there is a possibility it might actually slow down in the second half of this coming year.
Right.
Now, if you look at our exports, the debate you had just now, it's our entire small-scale exports which are doing very badly. And the pharmaceuticals, motor car, they're doing rather well. On the export side, at least, that tells me that the demonetization GST bugs are still biting. And they probably will still bite when the world economy, sort of gives up a little bit on its current exuberance. I mean, we've just failed in the exuberance on the export side, and I agree entirely with Swami that if you don't do well there, you ain't going to do well anywhere else.
All right, Swami, quick last word from you. What's your sense? FY19, the election year, here was a Prime Minister with an incredible amount of political capital, seen as a reformist, and, we would have a sort of going into election, is he likely to get anywhere close to that 8% mark?
As Maithili said, difficult, but I would say not impossible. If it happens, it will happen because the world economy booms sufficiently to create an export growth of 20%. I mean, I don't rule it out. Things have not done well so far, but could it happen in 2018 with a global boom? Yes, it could happen. And if that happens, it would help. It would also help because since the current year has been a bad year, coming down to 6.5. I mean, from this lower growth to get to 8% for 1 year, yes, that becomes that much easier. Whether you can sustain it is another matter altogether.
All right, will it be sustainable, that 8% growth that completely eludes India right now is really the big question. Will we get there is, of course, a bigger question on that. But thank you very much for the stellar panel that's joined us. Swaminathan Iyer, Maithili Bisnoor, Shakti Bhattacharya and Abhijit Sen. Thank you for sparing time and speaking to us as we discuss and debate what is advanced data of the GDP. And these are the numbers that the budget will hinge upon. So thank you very much for keeping your date with the India Development Debate this evening.
Don't go anywhere. Up next is Top 10 at 10 with Ruchi Bhatia. Keep it with ET now. Good night.